So for our final market update in 2024, today's Empire State Manufacturing Index plunged to 0.20 this month versus the 6.4 expected. And from 31.2 in November, prices paid fell. There wasn't much of a reaction, but by monitoring the ISM Manufacturing Index, investors can better understand the national economic trends and conditions. When the index is rising, investors anticipate a bullish stock market in reaction to higher corporate profits. But the opposite happens in the case where the bond markets fall because the ISM Manufacturing Index rises because of the sensitivity of bonds to the inflation. So an index of more than 50 indicates expansion in the market. If it's less than 50, it's a retraction. So in the manufacturing section, that's an indicator of what's happening in the economy. Today, bonds have traded between 4.2 and 4.5. That's been the window we've been in for the past 2 months. Rates will not go lower until we break below 4.20 on the 10-year Treasury for an extended period of days. So that's going to be what we want to see happen. And this week we have more news. On Wednesday, we have core PCE. On Friday, GDP, retail sales. So technically, last week was terrible for the bond market. We have to get through this window. And I'm hearing the rates might get cut again in December, but those are short-term rates. So while we think that, again, there might be 0.25% for the short-term rate cuts, we're going to hear probably a hawkish tone from the Fed that, they may pause this to really watch market data. Because you can't just keep cutting rates because you think you should. You have to really watch the data. With the recent election, they're going to have to see how the economy responds, if tariffs are going to be coming, because that is all inflationary. So while we cut rates, the Fed, in 2024, they've cut them 100 basis points. Yet the yield for the 10-year note has risen 80 basis points at the same time. So when my clients are calling and saying, wow, the Fed cut rates, my rate's 0.25% better, that is actually not true. Long-term rates are not tied into the Fed rate cuts. Fed rate cuts affect home equity line, credit card debt, auto loans, installment loans. They do not affect mortgage rates apples to apples. So we have actually seen a complete opposite reaction. Short-term rates have gone down. Long-term rates have risen significantly. Since September 17th, that was our lowest point in 2024 of mortgage rates. We have risen straight up, just literally like a rocket since that date. We are now, again, hovering at a critical point. Let's see if we can hold in this range. And hopefully in 2025, we can break through that 4.20. I don't even have any idea what's going to happen in 2025. But what we hope is that the Treasury market continues to go down. The best rates in 2024, again, we hit 3.64 on the Treasury note. Today, we are at 4.40. So let's watch that market carefully. If you have any questions where rates are, please feel free to reach out to me at 773-848-4144.